Happy evening to all of us here. Welcome to Back to Basics educational series on income tax. This is a first of its kind program covering the major income tax act starting from today 8th May to 14th June 2024 on every Wednesday and Friday. May I request today's speaker Prasanna sir and SIRC Secretary Mukala Subhadev sir to come and talk to the vice please. We will start today's proceedings with the invocation of IC Buddhism. That is all praise for IC Buddha as a mark of respect to our mother IC.
Yaesha Supteshu Jagrati Yaesha Supteshu Jagrati
Senior members are there. Yeah, also requesting some of the senior members to join the line of the commission. Please. Senior women chartered members can also join, please. Yeah, we recognize the presence of SIRC chairperson C. Ajami Geeta and SIRC vice chairperson C. Revati S. Raghunathan to join the writing of traditional land. As said earlier, this is the first of its kind program covering the major income tax act. Starting from today to 14th June on every Wednesday and Friday. You can either register for individual courses or for all the 11 series also you can register. That option is available. May now request SIRC chairperson Ajami Geeta to deliver a welcome address.
Happy evening, everyone. Happy evening, everyone. Sorry we made you wait 10 minutes later because we were
busy with EC meeting and we were finalizing certain things. We will be having our SIRC conference which will be held on 9th and 10th of August. So for that we were doing all the background work. So we struck up with it and in the meantime Rahman is doing all the arrangements. The purpose of this program, this is Back to Basics, this is the new initiative of this team under the theme of Knowledge Nexus. This Knowledge Nexus is nothing but a platform which connects with ideas and people. So under this theme, we would like to have one of the initiative of Back to Basics. This Back to Basics in the sense it will be useful for the people who would like to unlearn and relearn the new things, the things which they have studied a long back. And this is mostly useful for the people who have who were in industry and they would like to come back and start their practice, or after a long time if they would like to go back and touch upon their basics. So for those people it will be much more useful. Initially we thought of doing virtually so that we can touch each and nook and corner of South with the speakers across India, but later we realized the limitations of the virtual programs which we can do, so immediately we converted it into physical mode. So that is what it's a little bit delayed in making the announcement of this Back to Basics program. This is, as you know, this is a 11 days, that is 33 hours program. It starts with section 1, section 2 to end. Actually, it was designed to have it for 84 hours. 84-hour session, but we thought it's practically not possible to expect the members to come and attend for 84 hours, and that's what we have screened it so many times. We have restructured the program and somehow we brought it down to 33 hours, the 11 days. I think that is, and we thought of concentrating mainly on the areas which will be more useful, which will be more relevant for the professional to understand the basics. So in those areas we thought of giving more importance, there we put more hours, and for other areas which just brush up kind of thing, briefly we can go through also those kind of things whichever is possible. For those sections we have given lesser time. This is the first initiative we are taking, and we are starting with income tax, and later we are planning to go for corporate law, GST and succession planning, and all acts which are all will be useful for the practicing profession. So I need your cooperation, I need your support, I need your encouragement, we need your input, we need your feedback for us to do more and more, and we would like to be amongst you people to reach you out whatever you expect from SIRC. So this is a SIRC initiative, and one more thing, the program, the behind starting of this program, one more person is there, is Kota Srinivas. He is a Central Council member. Obviously he is also from Bangalore. We started long back in a couple of years back in Bangalore, this kind of program, where we received lot of appreciation and good number of attendance was there. So he was also insisting that no, you do this, you launch and do, because he is also the vice chairman of Direct Tax Committee in at HO level. So actually they were planning to have this kind of program for all the branches. He started with Direct Tax, but I am planning to take him to the multiple levels of all the taxes. So I need your support. If anything is just, you give us feedback. I don't want to see everything is good. No, I want to get the criticized way of having, so that we can improve much more. Where we can improve, definitely we will improve. Where we cannot improve, we will check for the solutions what we can do it better. So thank you very much. So, and one more thing, this is the first program of this kind. This is the first day, that's what we are here, and we don't come very often to don't disturb you in your way of the starting the program. At the same time, see this kind of encouragement, we're seeing Gopi. Just now I came to know that he's a visually challenged person coming all the way to the institute to attend this program. Really, Gopi, it shows your interest and it shows, it gives us more encouragement to do more and more programs like this. Thank you very much, Gopi.
Today's program is very huge. 4, 5, 6 and 9. 9 itself will take around 4 or 5 hours to discuss.
But we are sure that we are not going to compromise with the quality. Sir, we don't know matter, sir. You can go ahead and complete all your slides and presentations wherever it's possible.
Yeah, before I hand over the podium to sir, I now request SIRC Vice Chairperson Adevali Svetnathan to formally introduce today's speaker to the August gathering.
So the person who's the starting opening batsman for this program is K. Prasanna, a chartered accountant and commerce graduate with more than a decade of experience in corporate and international tax and transfer pricing. He has extensively advised clients on inbound and outbound structuring, holding jurisdictions and business model evaluation. And he also has extensive experience handling corporate litigations. He won the FIT fellowship scheme from the Foundation of International Tax, FIT, for 2018 and 19. And he's a regular speaker at ICAI study circles and the International Fiscal Association, and has contributed articles on contemporary issues. And he has contributed to the book on demystifying Section 194R, published by Tax Sutra. So I think he's taken up a tough job also, because when we start attending income tax classes, we don't know anything, so we'll accept whatever the teacher is going to say. Today he is going to talk to seasoned chartered accountants about back to basics. All the best to you, Prasanna.
Before we hear Prasanna, may I request the dignitaries of the dais, our office bearers, to present the speaker with the air purifying pot plant. This is a working initiative of SIRC of SIA. Since the 3 of our office bearers are here, requesting them to present Prasanna sir with a memento also.
This is also new one, sir. Today only we are starting this kind of memento. Actually, it's over, then it looks nice.
Chairperson has brought it all the way from Bengaluru for you. Over to Prasanna sir to take us through Act Income Tax Act 4, 5, 6 and 9. Over to Prasanna sir. Yeah.
How many of you are registered for entire program or? Very good.
All the levels.
So on this basis, we are going to plan other acts also, that is one.
Good evening, everyone. So, I have a difficult task. So difficult task of taking you all to 4, 5, 6, 9. If you look at section 5, 6, 9, in each of the section one can speak for hours and hours. The TGS has put me on spot to speak on all the 3, 4 sections together within 3 hours time, and we have close to another 2.5 hours time. So I will try to concise my discussion, focus on important areas. At the same time, I will not also dilute some of the key contents. Sure. So if you look at section 4, which is the charging section. If you look at section 5, it only defines the scope of a total income. Section 245 talks about the definition of total income. If you look at the section 2, section 45 or clause 45, it says income as referred in section 5, and there is a comma, and then subsequently if you look at it, it says computed in the manner prescribed under the Act. So therefore, the purpose of section 5, if you look at, it talks about timing, it talks about place, it talks about person in essence. How do we say it talks about person? If you look at section 5, subsection 1, talks about what is the scope of total income for a resident. Whereas subsection 2 talks about the scope of total income for a non-resident. So it does talk about person, resident versus non-resident. If you look at timing, it talks about accrual or arisal or receipt. So these are some of the factors you can connect it with timing. If you look at locality, does it talk about locality of a particular income? If you look at section 5, it does talk about in India, accrual arising in India, deemed to accrue arising in India, received or deemed to be received in India. So it does also talk about the place. Now, in order to fit under the ambit of scope of total income, first it has to become an income. Then only the purpose of scope of total income, if you look at, it merely goes in the form of aggregation of income. And it also says subject to provisions of the other provisions of the Act, which means section 5 yield to other provisions. So if you look at section 14, it gives you a list of several heads of income. Income from salary, income from house property, business or profession, capital gains, other sources. If you look at for each heads of income, you do have a separate charging section and computation section. So therefore, to fall under section 5, it has to fall under the ambit of either of these limbs, which I have put it in the form of a table. And then second, first it has to partake a character of income. The purpose of section 5 is just to see whether it accrues or arise in India or outside India, to which person, where does it. It does not make something to be an income. If something to be an income, then it falls under section 224 domain, which is what the income is defined under. And second important aspect, if you look at, is what happens to certain streams of income which may not fit under section 5. Then can we say it is not chargeable to tax at all. Say for example, your 47A, section 47 provides that there are certain transactions which may not be regarded as a transfer. Now, 47A, if you look at, if you violate some of the conditions, then it clawback the exemptions that were given earlier. To give an example, section 47, subsection 4, where it says any transfer of a capital asset by a holding company towards only one subsidiary, provided the only one subsidiary is an Indian company. If there is any transfer, then this particular transfer will not be subject to capital gains. Now 47A provides a condition. Whatever 47(4), that exemptions which you have gained, then you have to in the subsequent years follow a couple of conditions. One, you cannot convert the capital asset into a stock in trade. And second important aspect is that holding a subsidiary relationship should subsist for a period of 8 years. If this is not satisfied, then by virtue of 47A, this amount is taxable. But if you look at in the year of violation, this particular income never accrues. It creates a fiction under the Act. So can we say this doesn't fall under the ambit of scope of income, so therefore I will not tax it? The answer is no, because section 4 is overarching. So at the same time you look at section 5 for that matter. We compute the income for previous years. Previous year is defined in section 3, which says immediately preceding the financial year, that is what, immediately preceding the assessment year, period beginning April to March. In case of new business, it talks about when does the source of income come into existence for the first time for a business. So from that moment onwards, your previous year starts. But if you look at section 4 explanation, it gives an exception. Generally by rule, we compute the income for the period from April to March. Because of this proviso to explanation 4, it need not follow April to March. It says other than the previous year also you can compute. Why? Because say for example, in case of a person who is moving out of India, this happens in the case of a shipping income, 172 or 174 for that matter. If a person is going out of India, the crew goes out of India, then they have to file the return of income before they leave in India. So therefore, not necessarily you follow a previous year in that particular aspect. So until the date of departure, you do it. Say for example, discontinuation of business. Till the point of discontinuation, assessing officer has a power to assess. Likewise, in a specific case, if the assessing officer is of the belief, 176, where if he believes a person who is going to evade tax by transferring an asset, then he can assess that person at the time of transfer itself. He need not to wait for the previous year to get over. So these are some of the nuances when it comes to 3, 4, some bit of section 5. Now if you look at many of these sections, section 5 talks about source. It uses the word whatever source. So therefore, it generally need not to quantify or qualify a particular source. A source could be anything. But in principle, if you look at it for the income, it has to originate from something. So there is a difference between an income and a source. Why source is important is for section 9. If you look at section 5, source does not play a critical role because it says whatever source, if it is accrues or arise in India, then by virtue of section 5 itself, a particular income is taxable. In case of resident or a non-resident or not ordinary resident. But source is important when it comes to section 9, which we will deal little later. Now, all income will necessary as a source. If you look at the point of discussion which we had on 47A, the Act itself is a source. Act creates a fiction that this particular income will be chargeable to tax. Say 41(1), when there is a write back of liabilities. I owe a sum to a creditor, but I never paid. It's a trade creditor. Beyond a point, after 3 or 4 years down the line, I write back the liability. If you look at section 5, it never fit under the ambit of any of the limbs, neither accrual nor receipt is there in this case. But by creation of fiction under 41(1), read with 4, it becomes an income. But what is the source for this income? Is nothing but the Income Tax Act itself. Act itself creates a source. Say for example an arbitral award. We go for a dispute and tomorrow court put a order that A has to pay to B an award of so and so. The source of the award or source of that particular income or compensation that I am going to get could either be a court order or could be relevant provisions of a particular, say for example, enhanced compensation of a compulsory acquisition. Court gives an order or the relevant law provides for it. So that relevant law will become a source. One thing, section 5, it only says what is the scope of total income, but charge is only on the total income, not on the scope of total income. Right? Now if you look at the differences between a resident and non-resident. When it comes to resident, we do have 3 limbs, or rather, we could say 3 limbs. Accrue or arise in India, deemed to accrue or arise in India, and then receipt in India or deemed to be received in India. Now, paraphrase this with the not ordinary resident versus non-resident. Accrue or arise in India is common, deemed to or accrue or arise in India is common, received or deemed to be received in India is common. The only exception is any accrual or arisal outside India is not covered as part of scope of total income. And when it comes to not ordinary resident, there is a proviso which does talk about in case of business or profession control in India or a profession set up in India, then that part of income is also subject to taxation in India. We will come to a moment what do you mean by business controlled or managed from India, or what is a profession set up in India. Source versus accrual. Is there any difference? A source of income, like I said, is different from an accrual. Why is it so? Say for example, classic in this itself first point, take for that matter, rental income. What is my income subject to taxation here? Income from house property, which is the rental income. But what is the source for that rental income? It is my rental agreement on the property. So there is a distinction between what is a income and what is a source of an income. Source is something from which the income originates. So therefore these two are two different contexts. Whether the place of accrual and the source of income, is these two terminologies one and the same? If you look at the older ruling of the Supreme Court in Ahmad by Umar, where they have distinguished this, a place of income, a place of accrual need not coincide with the source of income. It could be in two different places. So if you look at it, these two in these tables, if you look at with regard to the first line item, the instrumentality for a rental income is the house. The source of income is nothing but the rental agreement I have. But the place of income could be where I exercise the right to receive. Put it in an example context. The house may be in Singapore. I may be in India. I can enter into a contract in Singapore or I can enter into a contract in India. Had I entered a contract in Singapore, then my instrumentality and source is in the same place. Whereas the right of accrual, where I can exercise, if I can exercise this in India, saying that you have to make a payment to my Indian bank account, then there is a distinction. So, not necessarily the place of accrual and then the source of income go hand in hand. It could be in two different places. These three could also be in three different places. So, therefore, there could be a distinction. Why the place of accrual is important is when it comes to a non-resident or a non-ordinary resident. Because when it comes to resident, accrual in India or outside India, it doesn't matter. In both the cases I have been covered. Whereas when it comes to non-resident, the place of accrual is very, very crucial. And the situs of the source of income, like I said, is very critical when it comes to non-resident or not ordinary resident. At the same time, why it is critical? It is also in the context of section 9. Because it deems certain accrual outside India to be in India based on the situs. There are several parameters which has been fit under section 9 to look at when does the situs brings back the accrual outside India to India. Now when it comes to business controlled in India, if you look at the proviso to section 5, so it does talk about income derived from business controlled or managed in India. So what essentially I have to look at is, where does the de facto control? I will not worry about de jure. What is there in the books I need not to be worried about. But in effect, who is controlling? That is what critical to look at. To what extent I will look at it? Control could be little transient. Today, if you look at, you have a certain phrase in various different sections. Say for example, 222E, which talks about dividend, talk about the substantial as 20% or 10%. Likewise, section 9, when it comes to indirect transfer, talks about at least 50% as a substantial portion. Section 79 talks about 51% beneficial loading power. So what do you mean by this? When it comes to control, how do I put this? So if you look at place of effective management, there at least depending on the nature of companies, which we will look at subsequently, it gives some indication. Whereas when it comes to control, whether 50% control is sufficient, 75% control is sufficient, or 100% is sufficient, which is not there. In my view, more than 50% is sufficient to trigger this particular item. This is slightly different from business connection, which we will deal slightly later. So this is some important aspect when it comes to business control in India. When this particular clause can trigger is, let's say for example, an Indian firm has a branch outside India. The branch could be controlled by the Indian partners. So therefore, if this control is happening from India, then whatever income I earned from that branch could said to be accrued or arising in India. So therefore, even in the case of not ordinary resident, this particular item is subject to taxation. Now the concept of receipt versus deemed to be received. Deemed to be received purpose is slightly simple compared to a deemed to approval or a normal receipt. Receive in a true sense what I receive. In other words, there is no different meaning other than this. But if you look at this particular phraseology, it also talks about received by a person or on behalf of. So therefore, constructive receipt is also covered. So instead of, let's say I have to receive a debit, instead of me receiving and say I owe someone, you directly pay to me. So the payment made by my debtor to my creditor is a constructive receipt. So therefore it will fall under on behalf of the assessee. So therefore a constructive receipt is covered. It only covers the first receipt. Why it is so important first receipt? If you look at the Supreme Court in Keshav will say this. If a non-resident earns a salary outside India, later point, if he wants to send the money to his family in India, I can't say the receipt is in India. The income accrued, the salary accrued outside India is already taxed either on an accrual basis or due basis or on a receipt basis. So by virtue of receipt again in India, merely by transmitting this, it cannot partake a character of a receipt. So therefore a receipt should emanate first in India in order to trigger a receipt basis of taxation. No, receipt outside India, if you look at section 5, accrual or arising in India or outside India is covered. Why receipt outside India has never been envisaged? If you look at the Direct Tax Code 2010, the draft, there we had four limbs. Receipt outside India was also included as a part of the Direct Tax Code. But it is not there. Probably they would have envisaged that anyway accrual outside India for a resident is anyway covered. Can there be a situation where I could have a receipt outside India? Could be one possible thought. There could be some example. Say for example, I as a resident go outside India and get an advance salary. If you look at section 15, advance salary is taxable on receipt. It never accrued. So it cannot fall under accrual or arising outside India. In India is also not possible. It is not received in India. So can a view could be taken that this is a receipt outside India which never accrued at all in this year. Subsequent year, when let's say I go on March March 24. And then April 24, he adjusts this amount against my next month's salary. Now, in the next year, this may not be again taxable by virtue of section 15 because advance salary is taxable on receipt basis. Possibly 1 lakh I could see. And second interesting aspect is when it comes to deemed receipt of 56,210, where if you receive any shares for an inadequate consideration and that difference in that inadequate consideration exceeds 50,000, then possibly it is taxable on receipt basis. What happens if I receive foreign company shares? We'll park this question for a moment because when we deal with section 9 on the transfer of capital asset India, we will also deal with situs of shares. This one possible corner from there in the receipt outside India. Now, deemed receipt, if you look at section 7, talks about accretion to our provident fund. So the purpose of deemed receipt, if you look at, unlike section 9, it says something which is not received. I create a fiction as if something which is not received as received. That is what section 7 says. You can also look at section 198, where it says when a payer makes a payment to you, he deducts taxes and he remits it to the government. So this remittance which he is doing it to the government is a deemed receipt by virtue of section 198. So therefore something which I have not received, it creates a fiction to say that it has been received. So that is the role of deemed to be received. Now comes the question of what do you mean by accrual? Briefly take a 2 or 3 minutes break. I think is going to speak. Then I will continue on the accrual.
Zoom the head. And the camera is a good picture. Video very unbelievable. Sir, Kota sir, you can address sir. Yeah, audible sir, audible. Delegate, sorry for the interruption. There is a special message from Direct Access Committee Vice Chairman C.A. Kota Srinivas sir. Over to you sir, please.
Yeah, good evening members. Welcome you all to this Back to Basics Income Tax series of study circle meetings organized by SIRC of LCA. First of all, let me congratulate the chairperson and team for organizing this particular program. In fact, we call this particular program as RETA, that is Revisit Income Tax Act 1961. We have devised and shared with all the regional councils and the branches to conduct this particular program. SIRC has started this. See, this is basically to go through the basics of the Income Tax Act. And once in every 2 or 3 years, it's necessary for each and every member to go through the basics. Because we assume that we know all the basic things, but when once we sit on the subject, we understand that we may be missing a lot of basics from each and every subject as such. So this is a program which is devised in the month of May and June, so that if we go through all these particular problems of the classes, so that once we get to regular work this is a program which will operate for 66 hours, I will assume. That is what she said, for 66 hours we are planning for this. So definitely in 66 hours we cannot, nobody can teach or cannot learn entire income tax act. But it makes some sense at least to go through all the problems. I should really appreciate all of you for taking interest in coming and listening to this particular program. So actually we have devised this program for almost 84 hours, where we can cover section 1 to almost section 290 of the income tax act, all the important things. Because of some other programs, we hear they are planned for 66 hours. Today's speaker is Prasanna. He's taking section 4, 5 and 6, taking you through the basic law of section 4, 5 and 6. At the end of this series of meetings, we will definitely be more benefited and more knowledgeable about the fact ourselves. So once again, I thank SIRC for giving me this opportunity. Prasanna, thank you for giving me this opportunity in the midst of the presentation. Where are you, Prasanna?
From Chennai, sir.
Yeah. Okay.
Possibly we'll meet next week in Bangalore.
Yeah, you are coming to Bangalore on 7th, huh?
Yeah.
Okay, members, please enjoy this learning of my only request is please attend all the sessions, not that 1 or 2 sessions. Please attend all the sessions. We have got some very good people who share that knowledge. It's at the end of 6 hours, all of us will be benefited with more knowledge and income. So wish you happy learning for the rest of the series on income. Thank you all.
Yeah, thank you both. Thank you. So today being the first day of all these formalities, from the next session onwards, like break-free movies, seamless sessions. Thank you.
So we were on accrue or need to accrue part. What do you mean by accrue or arising? If you look at precisely the income tax act, there is no definition of what constitutes accrue or what constitutes arising. It all emanated from the jurisprudence. Even if you look at the older jurisprudence in the case of EDs also, where it talks about accruing is a synonymous with the arising in the sense of springing as a natural growth or result. So it's origin like how tree sprouts from the seeds. That is what it talks about arising. It emanates from the source. But if you look at this particular ruling, they were little hesitant to differentiate between accrual versus arising. Somewhere they said it goes hand in hand, but still there is a difference between them. An accrual is an anterior point, and arisal is the later point, which is there as part of the second. The former connotes the idea of growth or accumulation, and later of the growth or accumulation with a tangible shape so as to make that particular income receivable becomes arisal. So an offshoot is an accrual which manifests in the form of a right to receive an income, becomes an arisal. So this is what they are defined in major rulings. If you look at, it has been used interchangeably. Likewise in Excel Industries 2013, which talks about income accrues when it becomes due, but it also accompanied by a corresponding liability of the other party. So therefore, not only you have a right to receive, but there should be a corresponding liability. Say for example, this we see in accounting standards as well, be it AS9 or Ind AS 1 and 5, or even for that matter ICD AS 4. talks about contract escalations or even for that matter other forms of high retention money, where merely you make a claim is not sufficient. The other party should also acknowledge it for you to make it as an approval. So this is one important aspect we have to be mindful of. If you look at when it comes to receipt, it uses the word on behalf of, whereas when it comes to income, it never uses the word on behalf of, because a right to receive is sacrosanct with the person to whom an income accrue. It cannot be with someone else. So therefore, the on behalf of as compared to receipt is never being used when it comes to income. But there could be an exception when it comes to clubbing of income. Someone else's income, while the income may accrue to someone, but it gets assessed in the hands of another person. Same is in the case of a trust, possibly in case of a discretionary trust. While the beneficiaries have a prospective, I may have an expectation that something may come from the trust. Although the trustee is not the owner of the particular asset or an income, but still it gets taxed. It never accrues in his name. But acts create a fiction by virtue of 164 to tax this particular income in the hands of a trustee. So therefore, there is slight difference between why on behalf of is used in receipt as compared to why it is not used in income. Now if you look at case of accrual, like I said, it is critical mainly because of we are dealing with different characters of person. He could be a resident or a non-resident. And there is a difference between accrual arisal versus receipt. Generally, once the income has accrued, you can't again tax it. What you receive is a debt due. If an income has accrued already, then what I receive is nothing but a settlement of a liability. So it can't again be regarded as a receipt. This is possibly clear from two different years. Say for example, March I make a sale, income has accrued, whereas in the next year if I receive, we won't tax that as a receipt basis. So these two are different. Only in exception scenario, an income could be taxed on a receipt basis, which could be advance salary or even for that matter arrears of salary. Generally arrears of salary, if I go by section 15(1)(a), it is due in the respective years. Whereas act as creating a fiction, someone will say I don't have a right to receive arrears, which will be decided in the subsequent years. In that particular year, I don't envisage in future someone will revise the salary or not. Say for example, pay commission. Many a times after several years, the salary gets revised and it is being paid back. So therefore, in those years, they will say there is no due. But if I don't charge it in the year of receipt, then it could possibly escape taxation. So therefore, by receipt, there are section exceptions why it is being taxed.
So basically, technically, income can never be received.
So for example, 56. Acts create a fiction that if you receive something on an inadequate, I create a deeming fiction, although it is not an income in a real sense. It creates a deeming fiction to an income that is taxable on receipt. The charge is on receipt. So therefore, the contours of receipt is applicable by an exception, or rather, it applies only to a limited situation. Predominantly, you will get covered under accrual or arisal. Unless someone say, I follow cash basis of accounting. So, moving on to residential status. You want this to be dealt in detail, or should I address important aspects? Right. So if you look at, I bifurcated this into two. Why is it so is because of 2020 amendment, 2020 or 2021 amendment. Now we have several days or several criteria to be looked at depending on the person. Say for example, someone who is a citizen of India or a person of Indian origin, either visiting India or is leaving India for an employment, then predominantly only one condition will apply under 6 months, which is 182 days criteria. Because the 60 days in the previous year plus 365 days in previous 4 years will not apply to them, because the 60 days get replaced by 182 days for a person who is leaving out of India to take up employment. Now if this is there, then we will again look at 6.6 to see whether he is an ordinary resident or not ordinary resident. If he satisfies either of this condition, he will become a resident. If he not satisfy either, he will become a not ordinary resident. But when it comes to a citizen of India or a person of Indian origin who is outside India, but he comes to India, then depending on his income level from Indian sources, let's say if his income is more than 15 lakhs, then that second which we 60 days getting replaced with 180 days, it becomes 120 days. So 120 days in the current year plus 365 days in the 4 years to look at whether he is a resident or not, in addition to 182 days criteria. But if his income is less than 15 lakh, I need not to be worried, it is still 182 days. This is what in substance this 6.A versus 6.C. But when it comes to other persons, say I don't go outside India for the purpose of employment, then the question of 60 days will be relevant. In some substance it is. But the issues that could possibly come up is, how do I look at this 15 lakh? Because 15 lakhs is talking about income from Indian sources. So therefore potentially when it comes to a resident, accrual or arisal in India is also an Indian sources. So that it could form some kind of a circular referencing. This is one particular issue which will be there. This 15 lakhs is even applicable for our deemed residency, which will come about in a few minutes time. Some of the nuances, how do I compute the number of days when there is a movement of people? Is the stay should be continuous? At Nova says it is continuous. It is based on the presence during the year. It could be at a stretch, or it could be you go back outside India and again come back to India, go back outside India, come back to India. For that particular year, whatever is the presence, I will look at it. Which date should be included? If I go out of India and again I come back to India, should I include both or should I exclude both? Or is there a possibility of including something and excluding something? If you look at the OECD model convention, it says whether you arrive or depart, it doesn't matter. In that particular day, you are in the country, even for a part of a week. So therefore, both days has to be included. But when it comes to Indian jurisprudence, it excludes arrival, whereas it includes departures. So therefore, some of the precedents I have taken out here, which says arrival to be included or excluded, or departure to be included or excluded. Exclusion of any specific days, say for example, in case of a permanent establishment, slightly I am digressing for 30 seconds or 40 seconds or so, there are some exclusions when you compute the number of days for which a permanent establishment is situated in India. Say for example, temporary intrusions in a particular event. Say for example, you are doing a construction activity. A sudden earthquake has happened. You suspend an activity for a particular period. When it comes to permanent establishment, this could be excluded. Even if you look at a month back, there was a ruling on service PE by the Delhi Tribunal in preferred chance, where they have said people who are visiting India and as a part of their presence, they were doing some service. Say there were foreign lawyers who have visited India. During their visit, their purpose of visit is holiday. But as a part of holiday, they did some work. When they wanted to compute a service PE, the tribunal said this: the vacation days could be excluded. Business development activity related days could be excluded. But if you look at here, there is no such exception. Even if you look at 9 subsection 1 subclause 2, when it comes to salary, it says leave period preceding or subsequent to the salary or service rendered in India should be included. So therefore, when it comes to here, there is no scope for exclusions. When it comes to visit. Now what happens in a situation where I go out of India for an employment, then in the subsequent years, if I visit India, 61C will apply because I was outside India in the earlier years. Now, as a citizen of India or a person of Indian origin, I visit India. Let's say April, May, I have visited India. Say for example, 50 days I was in India. I have gone back. For vacation, I have spent 50 days in India and I have gone back. Then later point in time, somewhere in October 2024, I resign my job, I come back to India. Now, when I compute the presence for 24-25, will I include my presence in India during my vacation, April to May? Because this was an issue in Karnataka High Court in Manoj Kumar Reddy case, where the court has said, see, if I don't exclude the earlier 50 days criteria, then I am rendering 61C invalid until I come back to India. So therefore, to harmoniously interpret 61A and 61C together, the permanent return, whatever visits I did, because visit is not a permanent return. Visit is different from permanent return. So therefore, before I permanently return, whatever is the temporary visits that I have done to India should be excluded. So this is one exception where, while you may be present in India, but possibly may not include those visits as a part of your computation. Now when it comes to purpose of employment, it includes business or profession which I go and carry out outside India. Not necessarily I have to take up an employment there. If I go and do a business, then self-employment is also covered, which is quoted as part of Abdul Razak Kerala High Court residence. An employee from India, seconded outside India, is also covered as part of employment purpose. Split residency is something nuanced concept which has been discussed recently in the Delhi High Court ruling in the case of Sangeet Malhotra, where what had happened is, somewhere in January, that person has permanently shifted his residence. His economic allegiance has moved from India to another country. When it comes to a residential status, we will look at it for a previous year, which is April to March. Whereas someone breaks his residency or breaks his ties with India and moving away from India from one particular period, then can I have a split residency? Let's say from April to December, depending on my presence, I will be regarded as a resident or not ordinary resident. From January onwards, I will be regarded as a resident of a particular. So, why this particular concept can come is because from Jan to March, you may earn income outside India. But if you are treated as a resident throughout the year, then the income earned outside India could also be taxed by virtue of Section 5. So therefore, this was a concept which has been discussed as part of this ruling, which I think going to gain some more developments in the future. One interesting area to watch out for when it comes to split residency. So April to December, I will say I am a resident of India. From Jan to March, I will say I am a resident of the other country. 6.8 deemed residence. In 2020, this particular amendment was introduced mainly to target certain persons who is a citizen of India. It does not apply to non-citizens. Only if you are a citizen of India, but you are a nomad, that you have ensured your presence in particular countries or various countries in such a manner, you won't be regarded as a resident in any of the countries and you don't pay taxes. So therefore, those persons were targeted to say that, okay, you being a citizen of India, you possibly able to plan your residential status in such a manner, you not being a resident in any of the country, at the same time you are not paying taxes elsewhere. I will create a fiction, I will treat you as a deemed resident of an India, thereby you pay taxes in India. Suddenly there were hue and cry happened because most of the Middle East countries, if you look at, they don't tax the salaried people. There are more number of genuine salaried class living there, earning an income, but because of the respective laws, they don't tax the salaried people. They only tax, they earn their share of revenue from different form of taxes, oil tax, or for that matter, if you look at, they also tax the business class people. They don't tax the salaried class. Now, what happens to those salaried class? Then subsequently, there was a clarification issued by the Central Board of Direct Taxes with the Ministry of Finance, where they say genuine workers will not be hit by this. This is just a clarification, but if you look at the wordings of 6.A, it says notwithstanding anything contained in clause 1, which means it is overriding our 6.1. An individual being a citizen of India having total income other than income from foreign sources, which means Indian sourced income if it exceeds 15 lakh, he shall be deemed to be a resident in India in that previous year if he is not liable to tax in any other country or territory by reason of its domicile, residence, or any other criteria of similar nature. Now, liable to tax, they have defined it in 229A. If you look at this, is mainly to overcome the Supreme Court ruling in Azadi Bacho Andolan, where what they have said is right to tax a particular person is the sovereign right of a particular country. If a country has a capability to tax, but it doesn't want to tax that particular people, then I will look at, is there a country's right to tax a person? If this right is there, that is sufficient to call it as a liable to tax. Now, if you look at the definition of liable to tax under 229A, it talks about in relation to a person and with reference to a country, means that there is an income tax liability on such person under the law of that country for the time being in force, and shall also include a person who has subsequently been exempted. So therefore, the wordings suggest that there has to be first a tax on that person, subsequently that particular law should exempt that person from tax. It is similar to our section 10. You earn any income, but by virtue of section 10, your income is exempt. So therefore you don't cover under income tax. You don't pay basically tax up to basic exemption level. You are not entitled to pay tax. So therefore these are some of the situations where you could fall under the definition of liable to tax. What happens in a scenario, the classic issue which comes time and again is when it comes to a person in Dubai. If you look at recently after COVID, lot of people have moved to Dubai as a destination where they want to grow their business from there. Now Dubai has introduced a corporate income tax. But if you look at the manner in which the Article 3 of their Income Tax Act talks about this, I will tax the business of a non-juridical person. But when it comes to natural persons, there will be a resident. If as a non-resident you go to Dubai, you start a business, you will be a resident. The Act will regard you as a resident because you are carrying on a business. They want to tax only the business income of an individual. Now, the salaried income was never part of the Income Tax Act. So, therefore, can someone say, I am liable to tax by virtue of their law, but they have exempted me? It's a possible question that will be there in everyone's mind. Unfortunately, if you look at, that is a law by which they tax their individuals. That doesn't mean that I don't fall under this exceptions. So therefore, possibly I may fall under liability because this definition was to ensure that someone should be there in a taxable territory. This is one particular issue which may come up when it comes to a citizen of India who is a nomad. Now, residents of a company, quickly if I got to look at this. Earlier, if you look at place of effective management was not the criteria. Place where the business is managed or controlled, the company is managed or controlled was a criteria. But worldwide, if you look at place of effective management or place of management was used as a tool to determine the residential status. So even if you look at many of the tax treaties that India has, Article 4 says a company will be resident is a place where this place of effective management resides. So therefore, if a company is regarded as a resident in both the contracting states, place of effective management is the factor that has been used to settle the dispute, dual residency. So India has adopted the concept as a place of effective management as a parameter to test the residential status of a company. So you have two different parameters. One, if you are an Indian company, you automatically becomes a resident. Or if you are a foreign company, if your place of effective management is in India, then you will be a resident of Indian company. But unfortunately, if you look at the tax rates, it is different. When it comes to Indian company, the tax rate you have, unfortunately, we have so many tax rates, right from 15%, 22%, 25%, 30%. So 4 different tax rates depending on surcharge. Another for each of the charge you have 3 different rates can come. But when it comes to A foreign company which has a place of effective management in India, the rate is only 40%. It can't be 22% or 25% or 30%. It is only 40%. In the explanation, they have explained what is a place of effective management means. Place where the business and commercial decisions are concluded. And they have issued a guidelines. Unfortunately, if you look at, there is no power which is given under 293 to issue the guidelines, but nevertheless they have issued the guidelines. And they have also issued a circular stating that this place of effective management will be applied only to those companies whose turnover is at least 50 crores or more than 50 crores. So in case of less than 50 crores, for the time being they have issued a circular that this particular provision may not apply to them. So I have to quickly look at, don't go into the slides, and put it simply. I will classify each of the companies into an active company or a passive company. In other words, what is the main business of that company? Do you have a business in that company, or is it a company which earns only passive income in the form of interest, dividend, capital gains, royalty? Unfortunately, your royalty is also classified as a passive income for the purpose of poem. And if you purchase goods from related party, sell to a related party, this is also regarded as a passive income. So this is never regarded as an active income. So if you are an active income, and if you have majority of the board meetings outside India, then I presume your poem is outside India. It is only a presumption. So therefore it is not conclusive. There could be potentially someone can control from India, but you merely conduct your board meetings outside India. Based on substance, they may look through. But as far as the guidelines is, they presuppose if you are active business, because your fundamental business, everything outside India, possibly it must be controlled outside India. That is the presumption that they make. But when it comes to passive income, they look to series of aspects to look at where essentially the business the business and commercial decisions are undertaken. If you have a senior management, then where is the locale of those senior management, whether they actually undertakes the decision. But if your board is standing aside, someone else is taking a decision, then who are those people, where are they located? So these are some of the parameters that they were looking at. When it comes to active business or passive business, some of the parameters also they are given. Your passive income should be less than 50%. Income alone is not the criteria. They want to corroborate this with the asset as well as employees. So the employees' presence in India versus employee presence outside India, the payment of employees of the relevant locations in India versus outside India, everything will be compared to determine active or passive. So in substance, this is a step process which they adopt, which is there as part of the poem guidelines, where the board regularly meets and decides location of the committee. If board of directors is not there, it is undertaken by the committee. So in substance, it is like a series of assessment questionnaire which we come across on a day-to-day basis. Likewise, we have to look at each of these aspects to determine if something is a passive, to look at where the poem is. With this, we are come to section 9. Let's see whatever I can cover. If you have any priority on this, I will maybe first address those. Anyone has any priority, or you want me to go with the same one? Yes.
So with respect to the deemed residency, like how will the income of crew member of a non-Indian shipping vessel will be treated? Like will their income also fall under the deemed residence rule? Because
See, Deemed residency will apply only to a individual who is a citizen of India. If a person who is not a member of a crew or not, right? You do have a specific explanation under 6.1 which says that the income which is earned in India will alone be taxable. Even if you look at ordinary resident versus not ordinary resident versus deemed residency, everything will come under 6.6, which means only the income from Indian origin is taxed. Whatever you earn outside India will not be subject to taxation.
Even when he becomes a resident in the
Subsequently, when you become a normal, see, for the time being, 6.1a is a fictional. 6.1a need not look at your physical presence in India at all. I don't have to go and compute what is your presence in India at all. If you are a citizen of India, you are not paying taxes elsewhere, and if you are not satisfying liable to tax, see, liable to tax also, if you look at, the criteria is mainly on account of domicile residence or any other criteria of similar nature. If you are taxed in some other country and not falling in any of these criteria, then you will not be falling under the exception. So recently, few months back, if you look at, there was an issue of the UK Prime Minister Rishi Sunak's wife, where she claimed the India-UK tax treaty benefit, whether she is entitled for India-UK tax treaty benefit or not. UK also has a concept of non-domiciled resident versus non-domiciled resident. In case of non-domiciled residents, whatever income that you earn outside of UK is taxable only if you remit it to UK. Otherwise, it is not taxable. So, your taxation is based on a remittance basis. So, if I strictly look at that remittance-based taxation as part of this parameter, am I liable to tax in other country by reason of its domicile? It is not domicile. Or by reason of residence? Answer is no. Or any other criteria of similar nature. There also, if you look at, there are views of a clause where he says that even a citizen-based taxation may not fall under the ambit of other criteria of similar nature. So therefore, it has to be by virtue of domicile or residence or similar parameters. So if I don't satisfy this, then I may not fall under that exception. So by virtue of that, I may become a deemed resident, and if I have any income, then I will be subject to taxation in India. See, the problem, the moment if you are a non-resident, later part of the period, if you become a deemed resident, then the issue will be some of the exemptions that you were enjoying may not be there. Say for example, interest on NRE account. It is only applicable for a non-resident. While you may be a non-resident for FEMA purpose. So there is a confusion. Should I look at non-resident as a FEMA, or should I look at residency status as per income tax? If you look at the definition, slightly it goes to say as per FEMA. What happens to your taxation of capital gains, long-term capital gains for unlisted securities? In case of a non-resident, you are entitled for 10% rate. The moment you become a resident but not ordinary resident, you no more entitled for that 10% rate. You will be subject to taxation at 20%. These are possible. Issues will be there.
As per FEMA, who is non-resident?
FEMA goes by intention, sir. One, it also talks about what is your previous, similar to our income tax act, what is your presence in India for the previous year. But when it comes to people going out of India for the purpose of employment or studies, if your intention is shifting out of India permanently for the purpose of employment, then from the day in which you moved, you will be regarded as a non-resident. So unlike in India, the residence or non-residence is for the previous year, where it is not for the previous year. The moment if your intent is go permanently out of India, you will become a non-resident from the day you left out of India. So section 9, if you look at close to several limbs are there. 911, which has 4 further sublimbs, talks about business connection. Then business connection itself is divided into 2 different subsets. A traditional business connection before 2018, which is also subsist now. And then we do have a concept of significant economic persons. Then you have a property in India, asset or source in India, then comes transfer of a capital asset. So these 4 aspects are there. Then you do have salary. Salary, 1, normal salary and salary paid by government. Then we do have the aspect of dividends, interest, royalty, FDS. The scope of section 9, if you look at, it is slightly different from, it is also deemed to accrue or arise in India, similar to your deemed to receive. But the scope of section 9 is slightly different from deemed to receive. Because if you look at deemed to receive, something which is not a receipt, it makes it a receipt. Whereas when it comes to section 9, it cannot make something accrual. Accrual is fundamental. What it essentially does is shifting the locale of that accrual. If your accrual is outside of India, then because of some economic allegiance towards India, because of some nexus you have in India, it shifts the locale outside of India to India. So some income, if it is not accrued at all, section 9 cannot make it to be an accrual.
Example.
Sir?
Example. Give an example.
So for example, same for example, we do have a business connection. Section 9 talks about 4 limbs. 911 talks about business connection or asset in India or source of income in India or a capital asset. If by virtue of section 5, like we discussed what is accrual or arisal, where it says there has to be something arise for you to trigger taxation. Same in the case of I make a sale, I do a business transaction in India, right? But that amount is payable after a particular point in time. Section 9, although it can create an accrual because you have undertaken an activity in India, but there has to be an accrual in the first place for you to shift that. If the income has not already accrued because of some conditions, let's say satisfactory delivery of a particular tools. If I install this, after installation, I have to ensure that this particular equipment works for a period of 1 or 2 months. After that 1 or 2 months only, I can understand whether this equipment has been manufactured according to the technical specifications provided by me. Then only I will make a payment. Now, until and until someone tests the equipment and gives you a certificate that it is as per your quality parameters that you have envisaged. Only upon that the income becomes an accrual. Then merely because an activity is undertaken in India, I can't fasten an accrual because of this. The purpose of 9 is only shifting the location. Likewise, when you do a gift, a non-resident gifting the shares to an Indian, shares of an Indian company, a non-resident is giving to another Indian. Now, by virtue of 911, it is a capital asset situated in India because what he sold is the shares of an Indian company. But he has never charged any consideration. 47(3) says any gift is not regarded as a transfer. There is no income at all. What will I achieve by section 9? I can't make something out of this transaction. So therefore the purpose is only to shift the locale of the income from one place to another. Otherwise what happens? This is mainly relevant when it comes to a non-resident or a non-ordinary resident. Because when it comes to resident, the fundamental cardinal principle is any approval or arisal outside India is anyway taxable. So I need not to be worried about section 9. But when will I worry is for a non-resident. If he makes any transfer of capital asset in India, assume for a moment the same capital asset, I am charged a lesser consideration compared to the stamp duty value or compared to the fair market value as prescribed under the relevant rules. Say for example 50 CA or 50 C, I violate any of this. Then to that extent 50 CA will apply to recompute my income. Now by virtue of 9, the non-resident will say, we discussed accrual as the place where you can enforce the payment, right to receive. That is where the place of accrual is. Non-resident is outside India. He will enforce the payment only outside India. So therefore automatically your income accrues outside India. But how India has a power to tax this? By creating a fiction. Although your income accrues outside India, now because of some nexus that transaction has with India, I shift the locale by creating a deeming fiction. So this entire section 9, if you look at, creates such fiction in different classes of income. This will come only if the accrual or arisal outside India. If the accrual or arisal already in India, then I don't have to go to section 9 at all. By 5 itself, my income is taxable. Now business connection, if you look at until 2003, there were no definitions at all. Even in 2003, an explanation 2 was inserted, which is similar to our agency related activities. Other than that, it never included. But if you look at way back in 1937, the Rangoon High Court discussed this ambit of what do you mean by business connection in the 1922 Act. This was a case where Visakhapatnam, who was in non-British India, lent a loan to people who are in British India. So because of this, is there a business connection involved? And after that, if you look at R.D. Agarwal ruling, where they sort of explained. They understood that it is a difficult term to explain. So therefore, depending on facts and circumstances of each case, we will see whether a business connection is there or not. If you look at even in 2003 explanation 2, it talks about an activity carried out by a non-resident in India. So therefore, in essence, in order to constitute a business connection, there has to be some activity which the non-resident has to undertake in India. If no part of activity is undertaken, then this particular business connection may not trigger. Say for example, generally we look at majority of the cases where Indian MNCs import goods. In most cases, what the transaction, will they say because the importer or consumer is in India, will we say there is a business connection in India? What the non-resident does is business with India. He ultimately load his goods, send it by a sea or air for you to take a delivery from the customs. What is the activity that he undertakes in India? Nothing. All is profit generating activity, right from sourcing of raw materials, putting quality, designs, manufacturing, marketing, everything happens. Marketing possibly may have, which we will look at as part of explanation 2. But other than that, all his activities were undertaken outside India, and merely he doing a delivery cannot be said there is a business connection. So there is a difference between business with India, business within India. What we focus here is business within India. So therefore, if you look at explanation 2, like I said, it says activity carried out. So therefore, there has to be an activity, business activity in India for you to trigger business connection. For a moment, we will keep SAP aside. This is a traditional business connection before 2018 which we are referring to. Now if you look at the ruling of the Supreme Court in earlier law, it says it's more than the business. It should be carried out by a non-resident and it should not be a stray or isolated activity. So if I have to constitute something as a business, it has to be more than a stray or an isolated activity, and there has to be some continuity involved for you to trigger a business connection, and it can partake several forms. Either you set up a branch in India to carry out an activity, or you do an activity through an independent agent or an agent for that matter. Let's ignore independent agent, through an agent. It could be in several forms. That is what it said. And each facts has to be looked at to determine is there a business connection at all. If you look at, it does only talk about business connection. Does professional will also be included or not? The court has said we have this doubts time and again, but courts have said business connection could also include a professional connection. The Andhra Pradesh High Court in GVK Industries, which was approved by the Supreme Court in GVK Industries in 2015, where they have gone through several decisions of the business connection from the past to look at what are some of the parameters I have to look at. So it is a transaction between a person of a non-resident in nature with an Indian resident, and it is a question of fact driven. It is too wide compared to what a permanent establishment which is defined under the tax treaty. Because for a PE to follow, it simply says a fixed place of business through which business or profession is carried on. Whereas here, a part of a business carried on is also sufficient. Then close, real, intimate relationship and commonness of interest is also they have discussed about. If you have a common interest, not only by virtue of, let's say, an AOP kind of a thing, even a holding subsidiary relationship could possibly manifest in the form of a business connection if Majorly we see from India perspective, the Indian entities were acting as a market service provider for the overseas entity for the sale that they are undertaking. So this could possibly be trigger a business connection in certain cases. There must be continuity of activity or operations of the non-resident with the Indian party. Like they said, stray or isolated transactions cannot be regarded as a business. But if you look at section 213 which defines business, it does talk about an adventure of a trade. An adventure could be one-off, possibly it may be a business, but that cannot capable to create a connection between a non-resident and an Indian or Indian continent. So therefore, an element of continuity should be there for you to trigger a business connection. A stray activity, although it could be regarded as a business, but cannot partake a character of a business connection. This is one important ruling which talks about an intangible business connection. Although I don't agree with some of the principles highlighted there, I just thought it was an interesting situation to discuss. What happened in this scenario is Volkswagen car manufacturer conducted an event in Dubai. But the end target of that particular event, they were launching a new vehicle, but the target audience of that particular vehicle were all from India. There were close to 150 clients have gone to Dubai to attend this event. They had made a payment to Nicolas Cage to come on a show, to participate in the event, meet and greet some of the participants, do a short 30 minutes of an interview, for which they made a payment. So therefore the question arises, whether the payment made by Volkswagen Finance to Nicolas Cage, whether it is subject to withholding or not. Where some of the traditional rulings on business connection, if you look at, like we discussed, what is the activity that Mr. Nicolas Cage has taken in India? Nothing. He was in Dubai, did that show, went to US. No part of activity has undertaken in India. But somehow the tribunal went on to a tangent. She say that if you look at the entire event, is for the purpose of attracting the Indian business. So it is India's entity. They have looked at business connection from the point of the payer rather than the point of a recipient to say that this particular income is taxable. And one another point which they have said is, if you look at 911 definition, it says income arising directly or indirectly through a business connection. This particular word through was explained in explanation 4 after the Vodafone judgment in 2012. So therefore they have said through means in consequence of, by means of, they have expanded this particular. What do you mean by through? So therefore this particular explanation was used to say that there is an intangible business connection. But the problem of reading this through, even for that matter of business connection or a property or asset in India, could lead to unintended consequences. The purpose of they explain this aspect of through by virtue of explanation 4 is to overcome the challenges addressed by Vodafone. So therefore, it is appropriate to read through with regard to transfer of capital asset in India rather than reading with regard to other 3 limbs. One possible conundrum could be is that in the initial years I may have a business connection. Later on I may close that business, move away. 6th or 7th year down the line, possibly some customer may come to me and then I will do a one-off transaction. If I read this aspect of through into this, because the through is also mean in consequence of the sale which is connected to my business connection in earlier years, I have done this service activity in the subsequent years. So therefore this conundrum, if I were to read through into other limbs, will causes unintended consequences. So therefore a view is this particular explanation 4 in 911 was introduced to overcome the challenge of Vodafone. So therefore it is appropriate to read the word through read with explanation only in the last limb, that is towards transfer of a capital asset situated in India. Now some of the exceptions which you look at when it comes to business connection is explanation 1b to section 9.1, which talks about if your activity is confined only to purchase of goods for export, then there is no business connection at all. If you look at any of the tax treaties that India has, you do have a preparatory or auxiliary exemption. Where on Article 5, Sub-Article 4, where majorly if you look at the third or fourth limb, it says any purchase of goods, even if you set up a branch in India and then purchase goods, it is regarded as a preparatory or auxiliary activity, because they never envisaged that a purchase is only a small portion of function. After that there could be any other activity, could be a production, sales and marketing, and then sales. So what they felt is why a preparatory auxiliary exemption was given is it is not easy to attribute an income to a minuscule activity. But imagine you were to do a purchasing activity for a distribution. For a distribution entity, purchase activity is a predominant activity. But if you look at exception to business connection, any purchase you do for exports, no attribution. It says it does not regard it as a business connection. Although you carrying an activity of purchase in India, still explanation 1b will come and save you. But purchase for sale in India, exemption you cannot claim. Yeah, sure.
I was just looking, I'm not able to see that. What are the decisions, Karnataka?
Which one? For Motilal Orient.
Motilal.
Motilal. So this particular ruling, Mushtaq Ahmed, what has happened is, he was a proprietor. He was doing a proprietary business in India. As part of that proprietary business, he was purchasing goods for export to his associate enterprise in Singapore. While on one side, you are carrying on an activity in India, and again, it's like two different segments. One, I have a proprietary business, and second, I do have a export. So there they wanted to argue that I should be given an exemption under 9(1)(b). The AR said nothing doing, you are doing an activity in India. If your activity is solely purchase for exports, then you will be given an exemption, whereas you are doing other activities. So therefore I can't grant an exemption, so therefore your approval is in India, so I need not to go to section 9 at all. 9 will come only if approval is outside India. If approval is in India, then I need not to go to 9. That's what the code said. This particular ruling, what had happened here is, they do advise to their own associate entities as well as to third party entities on the products that they can purchase from India. So therefore, you don't actually involve in purchase of goods. You are only giving an advice for someone to purchase the goods. Court had extended the exemption even for these activities. And you do have an exclusion from news agency or shooting of cinematographic film. This shooting of cinematographic film, if you look at under the royalty, 2021 there was an amendment which has happened where you earlier had an exception under royalty for cinematography, shooting of films. Now that exemption is no more available in royalty. But when it comes to business connection, that exception was not removed. So it has removed only partially. So these are some of the precedents which, landmark precedents which I have just listed it out. We have close to about 30-35 years. So what does explanation 2 says? So they carved it out into 2. Until 2018, what was the explanation is? After 2018, what has changed or what has transpired, why it has transpired. If you look at, it talks about for the removal of doubts, business connection shall include. So it is defined in an inclusive manner. So this is not only the definition of business connection, it could be anything apart from this as well. Carried out to a person who is acting on behalf of, which means agent. Technically, if I have to act on behalf of someone, then I have to be an agent. So our Indian Contract Act agency principles normally will come. Then they are given 3 limbs. Has and habitually exercise in India an authority to conclude contract on behalf of non-resident. One, I should have an authority and I should exercise that authority to habitually conclude contract on behalf of a non-resident. Unless his activities are limited to purchase of goods or merchandise for the non-resident. Why this exemption was given is, if the non-resident were to directly involve in purchase of goods, then your explanation 1B anyway allows an exemption. How different does it make if I have to do this activity through a third person? So therefore this exception was there before 2018. I don't have an authority, but habitually I maintain a stock or merchandise belongs to a non-resident through which I do a delivery. Basically, I could be a warehousing agent. Then third, habitually secures order. Now the issue will come, what is the difference between 1 and 3? 1 talks about conclusion, 3 talks about securing. Is it one and the same or slightly different? 1 talks about conclusion itself, whereas here securing. So therefore, it falls short of conclusion. You do until everything ensure this order may come to you. Conclusion alone is done by your foreign principle. Then, if that be the case, then this particular link may come possibly. If you look at India-US treaty or India-Switzerland treaty, the protocol explains what constitutes securing of orders. Now, in 2018, what has transpired is we had this base erosion profit shifting action plans. Some of the action plans, one of the critical action plans is Action Plan 7, which deals with permanent establishment, where they have said this. Many countries have been violating the permanent establishment norms by setting through some of the structures. Some of the structures that they have put in place is abusive to come out of permanent establishment. So therefore, they want to target those structures. If you look at the action plan, it does talk about a commission and arrangement, which is more prevalent in a civil law jurisdiction, India being a common law, which not possible by virtue of a contract act. What that structure is, I go to a customer, get a contract for a particular product. While the contract is in my name, but the obligation to satisfy the parameters of the contract is on someone else. In case of an agency, I can go, say my principal is going to do. Agent cannot enter into a contract in his own name. Agent can only say, act on behalf of a principal. Whereas when it comes to commissioner, I act on my own behalf. But the obligation to settle that particular contract is vested with someone else. Whereas this is not possible in agency relationship. So therefore, technically it may not apply to India, but nevertheless, this being a good thought process, India has borrowed it. So therefore, if you look at the changes which I have highlighted here, it says first limb remains as it is. Unless its activity is limited to purchase of goods, this particular aspect has been removed. Now, no longer exemption is available. Habitually conclude contracts or habitually plays principal role leading to conclusion of contract. I play a dominant role in a particular contract. I need not to conclude the contract, but I play a dominant role. This is not already covered in securing orders, but somehow not all of the treaties that India has this particular third limb. While your domestic law has this particular third limb, close to about 20 odd countries only India has this third limb of securing of orders with this treaty partners. So therefore, having that coverage as a part of this will give you a significant upper hand. So therefore, I need not to play a conclusive role. A principal role or a dominant role is sufficient to trigger a PE. Then it says whether it is in the name of non-resident for transfer of ownership or granting of rights to use property owned. This is similar to a commissioner concept, which may not be prevalent, but nevertheless they borrowed it and kept it. Maintenance of stock, the second limb remains as it is. Securing of orders remains as it is. So this is when it comes to agency business connection. So this is the need for amendment which they have given. Key terms which are just highlighted here. Some of the jurisprudence. Now you do have a concept of independent agent. Because in a treaty parlance we do have a dependent agent and independent agent. Indian domestic law also talks about an independent agent. Who is then an independent agent? Easy to say someone who is not a dependent. Now then who is a dependent agent? Question will come. Either by virtue of legally I dependent, in a way my control is vested with the principal. He puts that level of control on me so that I have small leeway for me to act. All my actions are determined by my principal. If these are some of the parameters, then contractually or legally, he is exercising all the powers over me. So therefore, I am legally dependent by virtue of either ownership or by virtue of conduct. Economically is a question where my entire business is depending on the business which the principal is giving. I am a sole agent for this particular principle. If that be the case, economically I am depending on it. If tomorrow his business is not there, my business will not survive. So therefore economically. And am I acting as an agent on my ordinary course of business? Anyone comes, if I do this activity, or only for someone I do this activity. As a part of this, act also look at merely you acting as an agent for multiple associated companies. Let's say A, B, C are there. A, B, C, all of them are related. If I as an agent, I act for A, I act for B, I act for C. I can argue my entire revenue stream is not dependent on A. It is also dependent on B or dependent on C. So therefore I can argue I am an independent agent. Vice versa with B and C. But Act says, if you are acting as an agent for one particular principle or is related parties, I will look at as a whole. Group as a whole, I will look at to regard whether you are a dependent agent or independent agent. Now another question comes is, I also have a multiple business. Let's say I do have a distribution business, I do have a agency business. Now when I look at economic independence, will I club business together to look at whether I am economically dependent or independent, or I will look at for the agency business. We do have a divergent rules, but principally if you look at the activity for which I am testing dependence or independence is for agency. So therefore, that particular business alone should be looked at. Unfortunately, if you look at the manner in which the wording of explanation 2 is there, it does talk about his business. So therefore, it gives an impression that the agent entire business has to be taken. That is agents plus distribution. But if you look at principally, agency business alone should be looked at for the purpose of determining the dependency. Then explanation 1 is slight amendment which has happened on account of 2018, where what they have said is, in case of business, other than the business having business connection in India, explanation 1A talks about attribution. To what extent I can attribute an income for a particular business connection. Now when it comes to business connection, we have seen that an activity has to be undertaken in India. So therefore, any income attributable to a business connection is only correspond to the activity which is undertaken in India. So that is what explanation 1 says. If you, let's say, if you do 2 activity in India, then I can attribute the income only to the 2 activity. It can't be for all the activities. Unfortunately, after the introduction of significant economic presence, this particular explanation was amended to say that this attribution related to activity or corresponding to activity will apply only to traditional business connection. For SCP, this attribution rules will not apply. Now we look at what is a significant economic presence. This business connection, traditional business connection in a nutshell. Now there is a slight change in 2018 versus 2020. So significant economic presence, why it came is because majority of the our understanding on the business connection is there has to be some activity in India for you to trigger a business connection. Because of development of the digital economy, many companies were able to operate in a particular jurisdiction without their physical presence. So be it any form of PE, we always look at physical presence as a factor for determining PE. So therefore, if you look at when it comes to Facebook or Google, all of us use them. They earn so much of revenue through advertisements without their physical presence. Of course, Google have their Google and Facebook later part of the years they have their physical presence, but that is only comes through marketing. Predominantly, they earn an income without any presence. All our attribution rules majorly focusing on supply side. That is, someone make a sale to a particular jurisdiction. If you conduct an activity in that particular jurisdiction, I will tax it. So what happens to demand side of it? There are so much of consumers in India through which you earn an income but you don't pay any income in those respective countries. So therefore, as part of BEPS action plan, you do have a plan of action for digital companies. How do I tax them? In case of a brick and mortar, we can easily tax because some part of an activity has to be undertaken in a jurisdiction. Manufacturing means you can't say in any one of the country they have to do a manufacturing. But when it comes to digital commerce, not so. So therefore, how do I create a nexus for these sort of companies for them to tax in a particular jurisdiction? So therefore, they have identified market could be a factor. In 2018, there was a draft report which was released as part of Action Plan 1, where they have given potential scenarios that could be adopted, but nevertheless it was never recommended. one of the scenarios what they have said is, you look at transaction come digital factor. Digital factor is nothing but number of users in a particular country. At the same time, transaction is nothing but an amount. If these aspects put together is crossing a particular threshold. What is the threshold? They never discussed. But both these factors should be looked at together for you to create a nexus with a particular jurisdiction. So India, although it was not recommended because many of the inclusive framework countries, close to 100 or 130 odd countries were discussing how do I determine the nexus. But India has borrowed that good to have this under the domestic law so that I will have a better bargaining power when it comes to the action plan one. So they have taken this aspect of digital factor plus transaction factor. It was a mutually inclusive factors that was suggested in the report, but we made it mutually exclusive. So if you look at limb A on the left hand side, transaction in respect of goods, services, property carried out by a non-resident in India. So therefore, here also if you look at a non-resident has to carry out some activity in India. And second limb, if you look at, first limb talks about only transaction level. Second limb talks about, here they have mentioned on systematic and continuous solicitation of business activity or engaging in interaction with such number of users, digital factors. Both were displaced and it was introduced in 2018. Now later on what has happened, some representations were made to say that this causes some hindrance. CBDT got better hold of that observation that the way in which I have introduced this, because of this activity carried out by a non-resident in India, which means what is the difference this and the traditional business connection. So therefore, I made a blunder, so therefore they changed it in 2020. Removed the word carried out by a non-resident with any person in India. So therefore, all our understanding on traditional business connection goes for a toss. You make a sale to India. Earlier our understanding was always it is a business with India. Now that business with India is subject to taxation by virtue of SEP if I crosses a threshold. Likewise, if you look at the second line, systematic and continuous soliciting of business activities or engaging in interaction with such numbers of users in India through digital means was removed. So any other mode you do, still SEP could attract. So therefore, the transaction limit with regard to limb A is 2 crores. Transaction, or rather the number of users limit, which was notified somewhere in July 2020 or rather 2022, is 3 lakh users. If you touch upon any of this, then possibly you may trigger an SCP. But one good thing is, this will have an impact only in case of India does not have a tax treaty with other jurisdictions. Otherwise, what you will do is, you will take a benefit under permanent establishment because there is no activity because of this having transact with a person in India. FTE cannot be created. For T to be created, there has to be some activity in India. Here, without any activity. So, someone will take a benefit under the tax treaty to say that SCP cannot cause any hindrance. But when it comes to non-treaty countries, you will have a problem of this 2 crore. The another issue which could possibly come up is what happens when it comes to systematic continuous soliciting of business. I am only going to solicit a business from a user, which may not actually translate into an income. So how do they attribute? Let's say today, I have a 3 lakh users. No income at all. This year I don't have a problem. Although I create an SCP, there is no income for me to attribute. But next year, if I were to do some transaction, let's say, many times we see, right, if you go and search some products in online, immediately in some of the social media, if we use, it keeps pop up. We have checked this particular product few days back. Do you want to buy? New products have come. We have seen from Amazon or Myntra, Independence Day sale has come. This particular sale has come. Everything. So it keeps happening. So they continuously solicit, continuously engage in interactions. But what do they achieve out of it? What is the income they get? For Amazon, one revenue stream could be sale of goods. If they sell goods, then I don't have to look at class B. I'll fall under class A because transaction in respect of any goods, services or property, I'll fall under this. But criticality when it comes to this is the data or information about users that I generate. I can monetize this. So much of users are interested in this particular product. Their age group is this. How do I then later on target those users? So why do Facebook don't charge us? Their revenue comes from the amount of time that we spend in Facebook or even for that matter Twitter or Instagram. Now they have gone up to Threads. So the time you spend is the consideration for them because they get a data pool, information which they can sell it. So therefore if you look at explanation 3A, for the removal of doubts, it is hereby declared that income attributable to operations carried out in India, as referred to in explanation 1, shall include income from such advertisements which targets a customer who resides in India or a customer who accesses the advertisement through internet protocol address in India. So therefore, if based on the data pool, Google generates an ad, some other US entity goes to Google Ireland and say, I want to target this customers in India, they place an ad. This income is accruing outside India. We will not have any visibility over who places an advertisement in Google. But if it is targets a customer in India, then for the purpose of attribution, SCP is created because by virtue of number of users. Section 9 talks about income accruing directly or indirectly. So this is indirectly by selling the advertisement based on the users. So therefore by virtue of this, although the transaction is between two non-residents elsewhere, but if it's were to target India, I can still tax this by virtue of having created an SCP by virtue of explanation 2A link B, and then I add those advertisement revenue stream as an income attributable to this SCP. Now look at the second way. Sale of data collected from person who resides in India. I collected the data from Indian people. If Facebook sell the data to HP for targeting the users, then this particular sale is taxable. HP further sells the data to someone else, it is still taxable. It never talks about the primary sale. As long as the sale of data belongs to a person resides in India, the fiction is created. Sale of goods or services collected from anywhere, this will get captured as part of your transaction link A. This is only by exception. So this is when it comes to SCP. We'll move on to transfer of capital asset in TTR because it is slightly critical.
SIRC will start applying it.
It has been notified. Your threshold limit has been notified. When it comes to the moment it was notified, the 2 crore versus 3 lakh users, it triggers. Until then, you were able to argue that the limits has not been prescribed. How do you then operate? But majority of the TT countries, you take a position. See, problem now is in the income tax form, right from year 22 onwards, they've asked you to disclose transactions related to SEP. So all the purchases, or rather all the sales and non-resident was done in India, has to disclose. They've started issuing notices. If you look at the assessment year 22-23, which got recently concluded, many of the non-residents were issued notices mainly on account of you made some disclosure in SEP by why no income is being offered. So unnecessary complaints issues. The other issue comes when it comes to 15 CP. What position you will take? Because 15 CP, if you look at any purchase of goods, you don't have to file 15 CP. But you look at if you take a TT position, then you have to file Part C of 15 CP. As a chart accountant, what position I will take? Or see, imagine for a company who deals with multiple imports from a third party. Where will you go and asking for a TT certificates? You will say, if you want, you buy the product, or leave it. I won't give you TRC. Unnecessary complaints from a 15 CP. None of them does because of a specific exemption under 15 CP form itself, where it says if it is for purchase of goods, you don't have to do 15 CP. But tomorrow, if you are to defend a 201 proceeding, then you need to have a TRC. That issue causes unintended consequences. So briefly on transfer of capital asset in India, this particular aspect was always there. But the introduction of explanation 4 to 7 manifested out of the Vodafone ruling, where Hong Kong entity, through series of holding structures, was holding ultimately the Indian entity. Hong Kong, and then you did have Netherlands, Cayman Island, Mauritius, and then India. Now they've sold the Cayman Island shares, only one share, close to about 20,000 crores to a Netherlands entity. But if you look at the Cayman Island or the Netherlands entity underlying or Mauritius entity, all these were investment entities. Ultimately, the entire value of business is derived out of the Indian business. This particular transfer was subject to tax in India, was the contribution of the department. If you look at right through Cayman's, the entire value is represented by the India assets. So what you sold is nothing but the Indian assets for which you have to pay taxes. The argument of Supreme Court has said is, you can't see through, you don't have provisions under the domestic law to see through until Cayman level to say that you can charge a particular asset in India if it is an overseas transfer. Someone is transferring somewhere, how do you create a charge without having anything under the domestic law? So therefore they said this, whatever the overseas transfer which they have done, because of the drawback in the domestic law, you can't tax this. Later on, explanation 4 was inserted to define what do you mean by true. That is where they have said by means of inconsequences of. a capital asset situated in India. Then explanation 5 was inserted. So this was inserted from retrospective, 1976 onwards. Later on they have toned it down. So what had happened in terms of explanation 5, they have said after this there was a Shom committee which was set up. They gave some guidance. Some of the guidance they have taken it, some of the guidance they have brushed it aside. What they have said is, okay, I will not tax all the overseas transfers. I will transfer only those overseas transfers which derive substantial value from India. What is that substantial value? What they have said is, two parameters we will look at. One, the value of Indian assets should at least be 10 crore. So therefore anything less than 10 crore I don't want to look at it. Not feasible to look at all the transactions. So they said okay, only do 10 crore. And second, the fair value of the overseas assets should at least represented by 50% from the fair value of Indian assets. So Indian assets should contribute at least 50% to the overseas assets. This is what explanation 5 said. Explanation 6 said, when do you look at this particular? Which date I should take? So they define what is a specified date. Will I look at the date of transfer or will I look at the last balance sheet date? So the date is only to determine when should I look at this 50% criteria. So they define two different parameters that I will go by your last balance sheet, provided between the date of transfer and the last audited balance sheet of the overseas company, if your book value has not undergone a change by 15%, then I will take last balance sheet date. But if between these 2 days, if your book value of asset is changed more than 15%, then I will look at the date of transfer as a specified date to look at this 50% criteria. This is what explanation 6 says. It also talks about the 10 crores and 50%. Now explanation 7 simply said there could be a situation where some small shareholders will be there. They might also transfer some of the shares. Ultimately, it may derive value from India. I can't ask small shareholders every time to say, hey, you come and pay tax. So therefore they say, if your indirect interest is only less than 5%, then you are exempted from this particular provision. Only applicable in case of people who are having more than 5%, directly or indirectly, then this particular provision will applicable. So there was an issue which came up in Augustus Capital, because these explanation 5, 6, 7 were introduced somewhere in 2015. Section 911 was amended retrospectively from 1976. Now after Vodafone, till this explanation was introduced, there was a FII who had a 4% stake. They had sold the shares. Department said indirect transfer provision is there, you have to pay taxes. So there the tribunal as well as the High Court said this. Later on you brought in a provision to allow exemption to a shareholders, small shareholders who is holding less than 5%. You should apply that particular ratio even to the earlier period. That is what? In sum and substance. This I will wind up. Few more slides are there. Possibly I may request them to give one more slot. Thank you all. Thank you for patience. Basically, we upload system on it. They said they will upload SIRC of ICA, go there, ask you to check, there is a result they will upload. I think the recording also website they will make available. YouTube, SIRC of ICA, there is a channel. Various I especially the office they are also doing the water. Future years will come to my